So now we will move into a panel discussion about funding in the tourism sector. So please help me warmly welcome the moderator for this panel discussion, none other than Jerry Mabena. A round of applause, please.
Good morning, everyone. Thank you very much to Minister Mackenzie again, and I think a big round of applause, if we may, please. I think this was a very, very exciting session. It's actually sad that I'm doing this session myself, and for me, it's a sign that we need to do a little bit more of this. It's the first time at TBCSA that we are hosting this particular panel, if I can call it that. And it's an important one because in a perfect world, I would have wished for us to have it as a workshop where we really get deep into the issues and we help particularly the small businesses that are in the room to be able to deal with the conundrum of funding, as I call it. And I have had the honor of really getting a few people who have taken the risk, because we have not done this before, to come and join us for this particular session. So I'm going to really take this opportunity to call the panelists up to the front. From IDC, we have the acting head of the Services Business Unit, Dineo Skwambane. If you may please come forward. From SEFA, we have Lwandiso Makupula, who is the Executive Manager for Wholesale Lending. And from the DTIC, we have Donald Mabusela, who's Senior Manager for DTIC. I'm going to wait for Donald. Sorry, I'm old now. When I sit down, I make sound effects. I forgot my phone down there, and it's got my questions, but it's fine. I've got them here somewhere as well. I think I'll start by getting the panelists to just introduce themselves a little bit and just tell us a little bit about themselves, what they do in the environment, and then I'll just get into a couple of the questions, just to give them an opportunity. I'll start with you, Dineo.
Thank you. So I'm currently caretaking for the Services Strategic Business Unit. Now, there's quite a bit that fits under this unit. So we've got tourism, we've got ICT, healthcare, as well as media and audiovisual. So all the service kind of related sectors fall under this SBU. The IDC in general focuses on manufacturing, hence the name Industrial Development Corporation. Just to talk a bit more around the tourism, our current book is around 2.1 billion, and that's South African assets. We also invest a little bit, but we also invest into continental Africa, or sub-Saharan Africa. A few of the larger transactions there. I would like to share with you, kind of our drivers. I know we'll probably have a discussion around the different types of financing, but our key drivers is development finance. When we talk about development, we're talking about transformation, supporting black industrialists or black entrepreneurs, women entrepreneurs, as well as youth. That's quite a big area that we are really working on. One of the examples that I want to share with you is the Premier Hotel in Thohoyandou. It's a black women-owned hotel, not in a key urban area. That was recently launched. So those are the kind of transactions that we do look into.
Thank you very much, Dineo. Lwandiso?
Thank you so much. I'm Lwandiso Makupula, the executive for Wholesale Lending at SEFA. SEFA is Small Enterprise Finance Agency. As the name suggests, we are for small enterprises. And it is true that there are small enterprises in tourism. To prove that there are small enterprises in tourism, Mabena, we have a program that we are currently running. It's a 1.2 billion fund program. Even though SEFA is not a sector-focused organization, we have sector-focused programs. And here today, I'm just going to talk about one, the one that I think is very important to you, the 1.2 billion fund. That 1.2 billion fund is sponsored by the Department of Tourism. I've not seen anyone from the department, but thanks to them. So we are there as SEFA, we are the implementers, or we are the implementing agent of the program. It is a good program, a very good program, especially for small businesses. In what way? We fund you not only with debt, there is also an element of grant. So let's call it a blended finance that is targeting at transforming the sector. Thank you, sir.
Thank you very, very much. What I'm going to try and do, and forgive me, colleagues, I like to behave like a standard 3. So I assume that I don't know much. So when I ask questions, I'm going to ask stupid questions. And that's merely because I know there's 1 or 2 people here who have the same IQ as I do, which is not very much. So I'm just going to make it as basic and as non-financial as possible. Is that okay with everyone? Thank you. Dr. Mabusela, your intro.
Thank you, Program Director. My name is Donald Mabusela from the Department of Trade, Industry and Competition. Within the department, I'm working within the branch that is responsible for administering incentives. Our incentives mainly support manufacturing and agro-processing. But now, with regards to the tourism sector, I've identified specific incentives that support the tourism sector. And I'll be giving an outline with regards to that kind of support. Of course, when you talk about incentives, as you might be aware, this is the money that you are not required to pay back. It's a grant, and through this we assist startups, and those that are in operation, we assist them to upgrade or expand their operations. But incentive schemes do not fund 100% your requirements. Depending on a particular incentive program and the nature of your business, in certain instances you might get 10% support, in other instances you will get 50% support as a grant, meaning that for the other portion, you as the business owner, you need to go out there and raise those funds. Thank you.
Thank you very, very much. So I'm going to paint a picture of an entrepreneur's conundrum. Having done a little bit of property management at some point in my life, and I'm going to use a retail model and then use a case of a hotel. And just kind of paint a picture, and that will start the conversation that we're going to have. In the case of a retail mall, if I go outside of this area here and I pick a piece of land and I buy it and I go through all the processes, and we'll talk about the processes of approvals, EIAs, changing your municipal right or rezoning and all those sort of things. When I come to a commercial bank and I go to Standard Bank, Nedbank, or whoever it is, and I say that I want to build a retail mall, what they basically will say to me is, how much occupancy have you got in terms of the retailers who have taken space with you? So if I've got a ShopRite or I've got some of the key tenants having taken leases from me, I can go back and count that as equity. Am I correct in saying that? I'm keen to see a nod if anybody agrees with me, because if you pre-sell some of that, then at least you've got some equity in the project. What I want to then say that in the hotel case, you don't have a similar thing, because in the case of a retail center, ShopRite would take a 10-year lease, so will Pep Store, and so will Vodacom. And by the time I get to you guys, I can actually account for a certain portion of the revenue that I get and say that there's money coming in, so I can pay the money that you are going to borrow me, because these guys are going to be my tenants. In the case of a hotel, you don't have that. So maybe I'll just ask Lwandiso to say that in a SEFA environment, if I'm building a hotel and I don't have that initial proof that I've got that money, how do you deal with my project? And then, Dineo, you can add after that.
So there is a mall and there is a hotel.
Sorry?
But there is a mall on one side and there's a hotel on the
Yes.
other side. I'm following your example.
Yes.
Both are infrastructure projects. We're not going to talk about that. I want to zoom into the hotel. I think when she was opening Lindelwa, she talked about dreamers. And we are there for dreamers because there is no equity. So you are funding the future. Hence I'm talking about the dreamers stealing from her. And if you have to fund to the future, you have to ensure that you have proper projections. And your proper projections should be supported by reliable and reasonable estimates. We look at the estimates, what could happen, what is the potential, what is the future. We are not looking into what has happened. We're not looking into the balance sheet, because the difference between the two, or in your example, commercial banks will fund you at the strength of your balance sheet, but we fund you at the strength of the project going forward. So that is the future that I'm talking about. So when we're doing that modeling, we know that we have to ensure that we build or into the model the factors like the development. And what is the factor that I'm talking about? And I'm talking about the factors like development. The time it's going to take for the project to grow. We have to give you reasonable interest rates. We have to give you proper payment holidays. We call it moratoriums, but we said you must not use a financial language, so that you can build into the future. Those are the things that we look at when we're funding a project like yours.
Thank you. Thank you very much. That's very, very clear. Dineo, do you want to add anything to that?
Yes, sure. So we'll have a very similar approach. We will really zone into what we call the marketing. What is the expected kind of foot traffic? What is the expected activity around the hotel? Look at it, whether international, domestic arrivals, and even the greater activity around there, including shopping malls. We may not fund it, but they actually feature when it comes to your hotel developments. And I'd like to use an example of where we look at the operator, the brand operator is bringing into that facility. We've recently approved Club Med, quite a significant development in the Durban North Coast. And that, the real draw card is Club Med's global presence. And the kind of resort activities, etc., that they will bring to the untapped part of the Durban North Coast. So that will be all part of the assessment of how do we get people to come through and spend as well.
Okay, thank you so much. Dr. Donald, you spoke about incentives. Maybe share a little bit with us on the programs that DTIC has, that can actually support some of our colleagues who are, and I would want the bias to go towards people who want to do guest houses, small hotels in non-urban areas. I think if we can sort of move in that direction, just.
Thank you, Program Director. With regards to the incentives, we've got two main incentive programs that support those who are interested in building hotels. The first one, we call it the Critical Infrastructure Program, whereby we are saying wherever you are building in South Africa, you'll require bulk infrastructure, the supply of water, electricity. There might be a need to build a road to your hotel. There might be a need to build a bridge so that customers could be able to cross the rivers. So we regard that as infrastructure that is critical to unlock your investment. And that is the kind of infrastructure that naturally the local governments are expected to provide. But now, as a department, realizing that there are a number of municipalities that have got problems, challenges with funding, the Critical Infrastructure Program was designed, CIP, in such a way that we pay up to 30% of the cost of that infrastructure. Which means if there's a need to build a bridge or to build a road to improve the supply of water, the supply of electricity, and any other key infrastructure that is critical for the successful implementation of the project, through the CIP program, we partly cover those costs. Now, the second incentive program is for those individuals who want to build hotels outside South Africa. Our support there is with regards to bankable feasibility studies. We've got a program called CPFP, CPFP, which is mainly for those projects that when they are implemented outside South Africa, they'll create an opportunity for the South African suppliers of capital equipment to ship their equipment to those hotels. So it's going to help us to promote exports of South African capital equipment. We call it CPFP, Capital Projects Feasibility Program. So we partly fund for the feasibility study of up to 50% of the required funding to conduct that study. Of course, the owner of the project will have to raise the balance of the funding. So it's CPFP and also CIP. Those are the key projects, incentive programs that assist business people in terms of them building hotels.
And this comes as grant funding, which means I don't have to pay it back, right?
Definitely.
So if you give to a small enterprise grant funding, whether it's the Critical Infrastructure Fund or the second one in terms of export, and I like the second one, by the way, because it supports the tourism value chain, and I think we may need to have some time then and break that down at some point, not today though. If I bring that to IDC as a small enterprise and say, this is my equity, how would you look at that? as part of the equity contribution of the guest. Is that sort of looked at favorably?
Yes, we'll look at grant funding instruments as
equity.
part of equity.
Okay.
The challenge comes in, is it enough for the balance of the funding?
Yeah. Okay. No, that's fine. Now, we speak about equity. I did say that I'm a standard 3 kind of guy. So we speak loosely about things like equity. I think it's important that if you don't mind, Austin, I will just explain the different funding instrument, whether there's debt, there's equity, and whatever other instruments there are. Then at least when we mention these words, everybody here understands what we're talking about. Austin?
Okay. So I'll break it down into 2 key areas of what we've been talking about. So there's your debt. So your debt is as compared to a mortgage bond. So you'll have your the capital that comes through to you that you utilize for the intended purpose, and there's a fixed repayment on that. Most of us funders have some flexibility. Especially for a new project, you'll have what we call a capital moratorium or interest moratorium, where you actually have a break in the beginning. So you're not forced to, try and scramble for cash before you actually have your steady revenues coming through, and you'll start repaying at a later date. Now, equity is what we call our silent capital. So your senior debt is more your active capital. It needs to be repaid. Your equity portion, the funding itself, for the most part, is used in the project. It can also be, if you've got land and it has a value, that is also used as equity. That is the silent part of the capital process. It is there for the base of your capital structure. And also to help you maintain solvency. It's patient capital. It's, some equity providers, or most equity providers, will expect a return on it. The return can be in the form of dividends, but these will only come at a much later stage, when the business is stable, thriving, and when most of your debt is repaid. So that's why we call it patient capital. You need to be patient for an extended period of time.
Thank you. I'm going to probably ask us to do 1 or 2 more questions, and I want to spend quite a bit of time with questions from the floor, because I'm sure there's a lot of things that we won't be able to cover that I'm sure the audience would like to hear. But before we do that, maybe just Mabusela, and then you'll be followed by Makupula. Just to say to us, what makes a good application? What are the elements that, if I want to apply for either a grant or a grant and a loan, what are the most important things that makes an application that is likely to succeed in your hands? What should I worry myself about that make sure that 4 or 5 key things that needs to be in that application?
For us at SEFA, Mabena, we look at, let's summarize it and say it's 2 things. We call it the jockey and the horse. The horse being the project. Is the project viable? It might not be viable today, but it's going to be viable tomorrow. Hence, I was talking about the payment holidays. Is the project going to give us the desired development impact? We are safe, we're using taxpayers' money. We have to have transformation. We have to create jobs. We have to fund youth. We have to fund people with disabilities. So those are the good things that the project must also bring. Then we go now, because I've talked now on the commercials as well as the development impact of the project. Then we go now to the jockey being you now, the entrepreneur behind. Do you have the skill? Do you have the discipline? Do you have the qualification? You might not have everything. In fact, 50% of the people who are applying at SEFA don't really have everything. When they come, we say, what financial or non-financial support are they looking for? What training can we put? What capacity building? What support before you get to the desired? If all of those are in place, then we do the banking. That project is bankable.
Thank you. Dr. Mabusela, in your environment?
Okay, yes. With regards to the incentives, the good thing about it is that you are not required to pay back the money. Number two, the fact that you have to raise the balance of the funding. Now, when you raise your balance of the funding, either from IDC or from SEFA, they'll make an assessment like my colleague has just explained. Now, that business case is the one that you'll be submitting to us. That shows that the business is viable. And then based on that particular reason, we're able to unlock the core funding from us. Of major importance is that there must be evidence to show that you will be able to raise your balance of the funding, because even if you get a grant, but now you are not able to raise the balance of the funding, you can't implement your project.
Yeah.
So the same documents that you'll be submitting to the funding agencies are the same kind of documents that you'll be submitting to us.
Thank you.
Thank you.
I'm going to give an opportunity for a few questions. Austami, I'm going to give an opportunity for a few questions from the audience, so that if we haven't covered some of the things, at least. I see there's a question here. And
You're a great moderator. You caught me off guard. I thought you were still going to carry on. Do we have a question?
Mine is case specific and directed to.
Can you speak a bit louder?
Yeah, mine is case specific and directed to Lwandiso. It's mainly around the turnaround times on the applications of the financing itself, which is a bit worrying for us, especially with this equity fund that was introduced in December. We just need to understand as to why is it that it's taking this long. We have a case right now that we have a tentative approval on it via email, and it's been a problem to even acquire, this is more than three weeks now, to acquire the facility letter from yourselves, saying people are on leave or whatever, or on sick leave, I don't know. And this is really, after it has taken more than, I think, 9 months for the application to be assessed, and we got a nod after that, but the facility letter has not yet come forth.
Colleagues, can I just ask that we make our questions sharp? I think there's one or two other people that also want to.
Do you want to take 3 in one row and then
I think
answer all 3?
Let's respond to this one, and then we'll go to the next one.
Perfect.
Lwandiso, I think it was aimed at you, the question, yeah?
Oh. I didn't get the question quite right, but the snippets of it, I think you're talking about your particular application that has taken longer.
That sounds like it, yeah.
All right. Maybe point number 1, after this session, please come talk to me, because yours, at least, it's a specific question. But on our turnaround...
Can we maybe leave it at that then? That the two of you, after this, you will have a little bit of a chat?
That's
and
fine.
then we give the other ones that are more general an opportunity.
Perfect.
Is that okay, Puti?
Perfect.
Thank you. There were 2 other questions that side again.
One here, and then I've identified
But the question came before. I think let's. There were two hands there before that one, unfortunately. The lady, yeah, that lady in the middle, and then the one on the same row, the one in the middle, and the one there. So, sorry to do that to you, but I think it's unfair to give somebody a mic just because they're next to it.
Okay, I didn't see the hands the same as you. So you're saying who? There she goes.
There,
she can
that's
ask.
the lady,
Please
yeah.
go.
Thank you so much. I actually had this question yesterday, but I thought that since we have...
Will you speak up a bit?
Good morning, it's Monana Dliwayo from South African National Parks. I actually had this question yesterday, but I thought that since we have, people that will be speaking on tourism funding and some finance, maybe I can raise this question here today, that, our sector has an opportunity to create so many, jobs at the same time, like humongous. So to young people, women, people living with disabilities and from previously disadvantaged communities and all of that. But those jobs are not socioeconomically, sustainable with a small inconvenience in the finance sector, like the rand against dollar exchange, with pandemics and with natural disasters. All those jobs are lost at once. So how can we, through tourism funding and financing, tourism financing, create, the jobs are already there, but how do we make them a little bit more socio-economically, sustainable, where even when there is disasters, people don't really, just stay home and do nothing and just go back to their communities and still not, like how do we make
We'll
them?
get that. Yeah. Just pass it on to the next one, and then we'll answer, yeah?
Good morning, thank you so much. My name is Andulela Suka, and my question is pertaining to guest houses in particular. So when you want to acquire a guest house, there's historical data that you need to have, which is a usual requirement for SMEs, but you find that these guest houses do not have historical data or audited financials for you then to be able to make projections, but you believe in the property and you think that the property does have potential. So then how would we then deal with that? Because I know SEFA does require historical data, but what if you only have future data? So I'd like to just know more about properties and how one can actually acquire a property as an SME. And another challenge becomes the payback period, right? Because you also need to pay for overheads when you acquire a guest house, then you also need to pay back the loan itself, and you also realize that the time it will take for you to be able to pay back even the loan itself is longer than the break period that you get when you need to start repaying your loan. So there's another issue, is that the payback time frame is usually like 6 months to a year, where you are given a break to not start paying your loan, but you can only start paying your loan after 2 years or 3 years. But then you find that because of the existing overheads, and you're also trying to understand the market, and you're also trying to build relationships with travel agents, it takes longer then for you to be able to do all of that, still break even, and still keep the guest house running. So my question is pertaining to, being able or learning how to better position yourself and ready yourself, because now we know that it's bumper season.
I'm gonna stop you there now. I think my moderator is also saying to me my time is up. So,
Okay.
But I think to summarize your two questions, and if you don't mind, I'm just gonna give them an opportunity just to answer those two. Yours is kind of almost foolproofing the funding for disasters or stuff that happens in the future. I think that's the one question. The other one is an acquisition question, as I understand it, is that sometimes the data that comes is not appropriate to be able to be given to you, to be able to give projections that allows you to fund. That's the one piece. And the other piece was the duration, I think, of the holiday. Either the loan holiday or the interest holiday, that sometimes it's too short, and also the debt period might be too short even for them to be able to kind of start picking up on the performance of the asset. And that's how I'm understanding the question. I'm just going to ask any of you to take it, I think.
I'll go first.
Okay.
So I think we're talking about funding in a sustainable way, or funding SMEs in a sustainable way. And at the beginning, or when you're making your application, you have your business plan, you have your projections. Come the implementation, the things may turn around and not be the same. So if we're talking about funding in a sustainable way, we're saying, then what do? We have a department as SEFA where we call a workout and restructuring. So in workout and restructuring, we're saying, let us reset, let us restart again. There is a COVID, it was never planned. You are unable now to pay every month, or you are unable to pay this big installment. So let us reduce the installment, or let us increase the term of the repayment. So that's how we do the sustainable funding. It takes time for most businesses to turn around. So we have to factor that into place. Remember, it took us 25 years to break even, just to break even. So if Mabena, when we're funding SMEs, we're gonna expect them to make profits tomorrow, then we are playing. So at times it's true that you submit the turnaround, or you making cash on fourth or fifth month, and we give you 6 months payment holiday. Please, my advice is that don't squeeze yourself. You must stress test yourself. You must always give yourself a buffer, and you must always give us the true picture of the business. However, if you don't do that, and we find that right through or along the line, we're gonna refer you to our department, still at SEFA, that are called, it's a workout and restructuring.
Thank you. And then the sustainability kind of improving the business for disasters?
That's a difficult one. I mean, that's why it's called a disaster. You know, when we look at companies, we also look at to what extent can they build resilience into the business? To what extent can they actually have sufficient cash reserves? So companies should not just be living on the edge, so that when something does happen, you topple over, but rather that you actually create a buffer. Not easy, you know, not as easy as that, but your more established businesses will have that. And, you know, testament to those businesses who did manage through COVID and through, you know, the various unrests we had and flood issues. What IDC did do was actually offer concessionary funding and some instance grant funding to help businesses see themselves through, especially the unrest and flood relief, disasters that, you know, happened, you know, very suddenly. And then I also wanted to just touch on you know, you've answered most of it, just from our perspective, in terms of planning for a business before starting. You know, sometimes entrepreneurs are just too excited, want to climb in, start, and then they're faced with problems because they haven't adequately planned. Yeah. Haven't, you know, looked at clearly at their marketing, started those inquiries that you were talking about. The pre-work is often harder than actually when you get into it, and that helps you with your obligations after finance has been approved.
I think to the panelists, thank you very much. I have been told that my time was up a long time ago, so I don't want Tammy to come and stand here. But a round of applause to the panelists, and if I may request that you indulge some of those that couldn't ask the questions during the break, if it's okay. So thank you very much for taking the time. I appreciate it. I know it's a very difficult conversation, and thank you for indulging us as well. Thank you.
Thank you so much. A round of applause, please, as they make their way off stage.